Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Sunil Subramaniam, MD at Sundaram Asset Management, and Chakri Lokapriya, MD and CIO at TCG Asset Management, joining in. Welcome to the show, gentlemen. It's a pleasure to have you on the panel. Sunil, let me start off with you first. Overall, if you go to see the way everyone has been talking about the markets right now and what the budget could have done, there was no real correlation we could actually figure out. Markets have gone berserk taking the budget announcements. Was this something that you already expected?
No, honestly, I don't think any of us expected this. We definitely thought the government would be forced to tax and especially tax the capital market because that's a kind of a soft target. It's all, people who have lots of surpluses who don't go to vote anyway. So it's generally that's how the LTCG, dividend tax, all this keeps coming. So there was that apprehension. The second was that actually a contra appreciation. At least I don't know what Chakri may feel, but we felt that the conservativeness, the finance minister may be too conservative in terms of this year, saying, "Oh, we are just coming out of a crisis. Let's tighten our belts and let's hang in through this year."
Hmm.
Pleasantly surprised to see the opposite, that they're actually taking on a close to 7% fiscal deficit. And another aspect is that this has not been done by fudging numbers. For example, they have gone one step further in transparency. The Food Corporation of India, which was an off-balance sheet item all these years, they moved it on balance sheet. So there's also an indication of more greater transparency, which was a surprise coming from India. We're not used to that. The other thing is the level of prudence in the projections. I think a nominal revenue growth, GDP growth is projected only at 14.5%, right? So if you consider that inflation at 4.5, you're talking about 9.5, 10% real GDP, which
Hmm.
considering the GDP numbers are YOY, last year being, this current year that we're running, it's definitely going to be a negative GDP growth. So on a back of a negative base, right, you're projecting, I think 11% is what our estimates say the GDP should be. They have taken only 9.5, 10. So overall, I think a good balancing act has been done by the finance minister. And honestly, running into the budget, there was an apprehension on will they be able to achieve this balance. And I think on the whole, I would say that, and I was there on channels yesterday, I think I would rate it at about 8.5 out of 10, given the circumstances.
Absolutely. In fact, Chakri, taking the same question with you, do you think that the government has actually chosen growth over fiscal consolidation, and that's just exactly what the markets actually wanted to hear?
Good morning, Hirul, and good morning, Sunil. And thanks to all the viewers for coming in. I think Sunil is absolutely right in terms of, there was this fear that, the finance minister may be conservative, and, this was not the time to be conservative. You had a situation where the economy was locked up for the whole of last year. Usually whenever there is a problem in terms of whether there is a recession, and it's usually caused by one of two factors. Either there is a supply side shock or there is a demand side shock. Here in this situation, you had an artificial condition where, if I wanted to go out to a restaurant, so which means the demand was there, and you had a restaurant owner who was willing to supply, but because of the lockdown, both were artificially closed.
Hmm.
Now, as the lockdowns are opened, and as people are willing to go out and corporates are willing to go out, you needed a budget which will give them the confidence to go out and spend. So this thrust on healthcare, one of the most vital things, as we have learned very quickly in the last 1 year, and infrastructure, which our country needs. It's a large country with large needs. And I think so the government did the right thing, the budget did the right thing by going for growth. Deficits can be tackled a few years down the road.
Right. So, Sunil, would you call this a responsible and growth-oriented budget from here on, taking into consideration the path-breaking initiatives that the finance minister has announced, which will actually spur the economy and ensure that India grows extremely well for the rest of the decade?
Yes, actually, I labeled this the four P's budget.
Hmm.
Okay, so first of all, it is a prudent budget. It was a practical and pragmatic budget, and it is a pump priming budget.
Okay.
So, they say 4 P's of marketing. So for me, the 4 P's. So, I think to that extent, it's a very, normally this prudent pragmatism and pump priming cannot come in the same sentence. But that's what the finance minister has achieved. So I
Mhm.
think compliments to her on structuring the package in such a way that there is the impetus for growth. I think, and clearly, if you look at it, 14% was the increase in the nominal revenues that they have projected, but 35% is the increase in the capex expenditure. So, clearly the priorities aligning them, they have actually not done anything to boost revenue, expenditure, which I think is the greatest base because revenue expenditure goes away in a matter of months. It pops up demand for a short while, but capex has a greater multiplier effect in the economy. And I think that is a wise decision to actually do that. And this is what may allow India to get away from a rating downgrade. Because otherwise, with a fiscal deficit at 6.8, normally a country like India is not supposed to sustain. Our FRBM said we have to glide to 3, and we are going to 7. So
So,
I
yeah.
think this is the factor, this quality of the expenditure proposed, because it has a gain effect in future years' GDPs, is what might help us. It's a get out of jail card. Otherwise, a rating agency, they would have looked askance at this whole thing. Still don't know how they're going to react. I think Moody's has already done a little bit of noise. We'll have to wait and see S&P and Fitch. I don't know whether Chakri has got any news from them.
Absolutely. In fact, Chakri, anything that you would want to add on the same?
I think it's all the pushing the right buttons because capex, it's a very good number, 34% increase. And mind you, because last year a lot of the thing was locked down, they couldn't do nothing much, and even before the whole pandemic started, we were slowing down. So there was a need, and in this environment where inflation is also unfortunately largely under control. And in this environment, we have seen GST collections beginning to actually creep up above that 1 lakh mark, which is a good sign. 1 lakh crores. And so against this environment, so what is needed? When there is a capex, one, there is a multiplier effect. Second, it also in effect lowers long-term inflation because a better connectivity lowers the cost of doing business, which is a more sustainable thing. And so I think the government has clearly both its heart and mind in the right place. And clearly, this is something which will now generate employment. And along with the PLI, it will allow companies to actually expand their capacities and therefore bring in employment, which is much needed in this economy.
Absolutely. And in fact, if you read the budget or hear the budget speech clearly, tells you that the government has actually spent in fiscal year 21 and they've spent to clear some past dues and clean up the budget accounting. So it's clearly giving itself a fiscal long rope over the next few years. And that's something which is going to be prudent. But Chakri, one more thing I want to speak to you about right now is how markets are looking at this entire gamut that has come in because clearly the analysts that you speak to also are of the opinion that the spend with regards to infrastructure was something that was a missing link over the last couple of years and that has come in perfectly in line. Would you agree with something like that?
Yes, this spend and the to a targeted spend is very vital. Traditionally, we've had farm loan waivers, etc., very unproductive and which has stressed a lot of the banks. And on one hand, spending on capex for infrastructure, and on the other hand, making the banks, setting up an ARC form of an asset reconstruction company, which will help, clean up their books and therefore ability to lend and also bring down the cost of lending. Now, two very important things for a company or a consumer to go, if I want to go out and buy a house or a company wants to set up a new factory, both a lower interest rate helps. So, and during these periods, there's always a low correlation between current GDP and the stock market. The stock market is usually ahead, forward looking. So I think these gains will sustain over the period of over the next foreseeable future for the next year or two. Of course, there'll be corrections in between, but I think it's an upward trending market.
Absolutely. Sunil, would you agree with this? Do you think that this budget rally is something which could extend further? Because Sensex, we've crossed that 50,000 mark yet again for the second time right now. And now the stakes are really high because the anticipation was that probably you could see some bit of a correction right now, but I think there is no looking back from here on.
So two things here. I agree with Chakri that this rally is generally sustainable. But I'd like to point out two things here. One is the rally over the last, from March onwards, right, has been FII driven. I think they've pumped in
Hmm.
close to 2.5 lakh crores into the Indian market. Domestic MFs have sold close to a lakh crores in the same period, partly because they faced
Hmm.
redemptions, partly because they were hesitant to buy that which the FIs were buying because it was a very polarized rally. So though the Sensex may be at 50K, it's 2025 stocks which the FIs are favoring, which has taken it up. Even yesterday and today,
Hmm.
I would suspect it is still the FIIs who have been very relieved with the reformist and pro-growth budget and are pumping in money. But I think that this growth momentum that Nirmala ji has given will now get the confidence of the domestic MFs and others back into coming into the market, and start buying. And it'll also make retail investors who have been redeeming because they've seen the markets going up, but they've seen that lockdown in their lives. Stuff is not normal. Why is the market
Hmm.
going up? Let me book my profits. Now they will realize, the retail investor also will realize that, oh no, there is a growth oriented budget. So I expect net flows from domestic investors to turn positive. I expect domestic mutual funds to start buying, but they may not buy what the FIs are buying, right? So what they will buy is pro growth, pro infrastructure, and for
Hmm.
them the anvil on which they can buy is far wider than an FII. An FII is limited to, let's say, 100, 150 stocks in the universe,
Hmm.
of the market. But a domestic MF can look at the BSE 500 set of stocks, right?
Hmm.
So what I think is going to happen is that this is going to be a broader rally in the sense that within the Sensex or the Nifty itself, you're going to see a greater sector-wide participation and not
Hmm.
just 2025 stocks. And beyond just large caps, you're going to see across mid and small caps, those which are sensitive to the domestic. So even the mid cap and small cap rally which has happened around pharma, has happened around IT, where the visibility was there. But the
Hmm.
cyclicals, the infra-related, cap gold, cement, steel, those things are still way off their lifetime highs. So I think that that's where domestic MFs will see value. And I expect that this next leg will be a broader rally. So I would argue that a BSE 500 would deliver a better return than a Sensex because in the Sensex, certain components are already trading at a very high valuation. There are
Hmm.
others which will catch up. But so the Sensex itself may not go up that much, but you'll see the overall broad, the Indian market will really, expand because added to it is the fact that we are now having an IPO boom. See the number of IPOs which have been coming up. All those will enter at the small cap and the mid cap space. The PSU disinvestment. Again, that will be a new set of stocks entering into the space. So I think you'll have a broader and deeper rally in the coming years. And that's what is most sustainable because right now there is still the fear that is very polarized. And so a lot of people were apprehensive about that. I think that will come to ease gradually over the period as we see these plans being implemented.
So Sunil, would you be of the opinion that participants should be selective in their approach now?
They should be diversified in their approach. They
Hmm.
should be domestic economy sensitive in their approach. So they shouldn't just buy that which is just going up. They should buy, they should look at the economy. They should look at, so where is the finance minister spending this 5.5 lakh crores, right? He's spending a huge bunch on highways and roads, about a lakh crores on railways, a significant amount on healthcare infrastructure, right? So they got to look at in developing that infrastructure, what's the kind of companies which are going to get orders, and do that. So I would say that diversification is the need of the hour as opposed to polarization, which is what the last 1 year has delivered. So I think that fundamentally they don't need to be picky, but they need to make sure that they put eggs in a lot of baskets.
Absolutely. In fact, Chakri, the budget was an event that everyone was watching out for. After that, you have the RBI policy, which is in focus. But leaving these two, how important are global cues and corporate earnings going to be? Do you think these are the next leg that everyone should be watching out for as well?
To begin with, I think RBI has done a wonderful job over the last. The governor has done a phenomenal job, and I think he understands that liquidity is continues to be needed, and there is going to be government borrowing, increased government borrowing now because of after the budget, and therefore I think he clearly he's cognizant of that, and they will take steps to ensure the liquidity and then the yield curve is managed appropriately. And second, you're talking about global cues. First, before the global cues, on based on what Sunil said, if you look at the whether it's a Nifty versus a mid-cap index returns, there is a huge amount of negative correlation. In a year like 2018, when Nifty was up, you have actually the mid-cap index was actually negative for the year. So, which means today, if a Sensex is at a 50,000, it does not really mean that, oh, we are at a lifetime high and therefore we cannot move higher. Yeah, as Sunil mentioned, there were only about 10, 20 stocks which drove the whole rally. We have 7,000 stocks in this country. Okay, leave out several thousand, but there are at least a good number of stocks that you can focus, investable companies, good companies that one can focus on. And you have several of these mid-cap companies or broader or diversified universe, because if an infrastructure is going to do well, the auto industry is going to do well, the auto ancillary industries, like for example, commercial trucks have to transport goods from A to B. Cement companies are needed. If auto companies do well, auto ancillary companies will do well. And the building material companies will do well. So, and all these companies do not exist in the Sensex. They exist in the broader universe. And therefore, clearly there is a need to look at that. And now the global. Now the US is going to inject probably another stimulus of about $1.8 billion. This does a huge amount of reflation to global sectors like metal, oil, chemicals, textiles, and all of pharmaceuticals, all of which in which India, diversified companies among the broader based universe are fairly strong at. Look at the number of very strong chemical companies that we have, or look at some of the engineering companies. So I think that is the approach to adopt, where we will expect to see accelerating revenue and earnings. And then the trick becomes to identify those companies, or as we roll out over the next couple of years.
Right. So with this, all of us have been talking about an infra-oriented budget. The government has finally realized that infrastructure spending is something that is going to lead to job creation, and infrastructure development will probably lead to efficiency as well. But with that, Chakri, do you think that the way the banking index also moved in yesterday's session, or the way we're seeing it today, it could lead the next leg of the rally along with infrastructure?
The banking index has actually over the last 12 odd months has not, if you look at the front line, HDFC Bank, Kotak Bank, they've actually not led the rally. You have some of the diversified universe, and these were various concerns. One, we were cleaning up, the banking sector was cleaning up the NPA books just before the lockdown. Then you had the moratorium, and now you have the NPS coming under control. And in this budget now, they provided another 20,000 crores to the PSU banks. And mind you, most of the corporate lending still sits with the public sector banks. And infrastructure are long dated projects. They create employment in the short term, because let's say you build a road from Chennai to Bombay. From Chennai to Bombay, all along, workers, road layers, engineers, various kinds of workers, they find immediate employment. The returns come much later. So in terms of economy is pump primed, to borrow a word from Sunil right at the beginning. Now, but what you have to also look at, you also have the global things which will support, because metal companies will do well. I think so. This is the backdrop that we will adopt.
Absolutely. And then with this, Sunil, a couple of things that we've already spoken about is that the highlight is that clearly, with regards to where the fiscal deficit is concerned, that is a bold step that the finance minister has taken by raising it up. Apart from it, push with regards to infrastructure is something that everyone has appreciated. Now, if you come on the FDI side as well, how would you look at the FDI in terms of where insurance goes? Because insurance industry is really capital intensive, and now they've allowed not only FDI to 74%, they've allowed control with certain conditions to foreigners in insurance as a sector as whole. How would you read this?
I think it's a fantastic step because insurance is a very capital intensive industry.
Hmm.
And they've given enough chance for domestic industrialists to put their money into insurance and to take it up. But honestly, the kind of capital you need, because you're dealing with 20-year, 30-year kind of a prediction on the life cycle of a person or age, and you need to build in a lot of risk capital. So capital requirement is huge. And clearly for a nation like India, and especially, while LSE continues to be the market leader, right? It is the penetration of insurance in India is among the lowest in the world, right? So I think that two things. I would look at insurance not just from a pure FDI angle. I would look at it from the healthcare angle. See, India as a country, given our population, right? We don't have a social security net or a healthcare net. Can you believe that in the UK, 100% of people's healthcare is financed by the government?
Government, correct.
Right? India is zero. So we don't do anything. So the point is that there are two tackles. So healthcare infrastructure, which they've built in, 35,000 crores for COVID. I would look at insurance as a way. Ultimately, if you remember, the Prime Minister launched Modi Care, as we called it then, like Obama Care. A few budgets ago, they had announced the free insurance. And even now, I think you can get for 12 rupees, right? I think you can get insurance through your bank account. So I think insurance is a way to provide a social security net, because ultimately for our country, right, we need to take care of that. So I think this is a very progressive move which caters to both the welfare society angle of India as well as to the development angle that we need foreign capital. So I think the financing of this, I think it's a very positive step. And you may give 34%, but you don't give management control. Then again, foreigners will say, what's the point in having a financial stake of 74% when I can't do anything to that company? So I think it's a recognition of the fact that it's just money comes with accountability and with responsibility, and that's why we're giving it to you. So I view this as a very, very positive step from that perspective, because the other thing which is happening in India is the financialization of savings, right? So as all of this works through in terms of infrastructure, job creation, and our per capita income starts to rise, you'll have a greater amount of capital going into the financial markets. While equity mutual funds and debt mutual funds are one aspect, insurance is also another financial asset class, right, where there's a huge potential from a penetration perspective. So I think to truly, and ultimately, if you look at an insurance company, right, we may talk about insurance. I looked at it from the perspective of providing protection to the citizens of the country, easing the burden of the government in terms of welfare. But there's one more important aspect of the insurance industry is that they are vital players in the capital markets. You know how LIC has been a big supporter. So I think other than the mutual fund, in India, no, it's not a problem, but the domestic mutual fund industry does not manage the assets of the insurance industry. The insurance industry manages its own assets. So they're a very big player. So actually the insurance company's growth means that government has provided an alternative source of financing. See, ultimately the capital markets have to finance India's growth. There's a limit to which a government can go on with borrowing, fiscal deficit and pumping infrastructure, right? So one way is FDI, one way is domestic MF, another way is domestic insurance. And I think long term, this will mean that Indian economy's financing actually is the fiscal deficit burden on the government if the capital markets rise and support the growth of this country. So I think that the move is significant from a number of angles.
So, Sunil, would you agree that the announcements that have come in would be comforting for the FIs to continue to be invested in India or probably increase their allocation to India?
I think the 2 days market action already speaks for that. But I'll tell you where I feel that definitely what you say is true is because a significant proportion of the capital that comes to India is from pension funds and retirement funds. And yesterday also in the budget, she included a tax relief for the retirement funds from overseas to avoidance of double taxation. So I think you'll see good long-term money which has got a 20, 30-year outlook come into the market. Otherwise hedge fund money is here today. They call it hot money, can go tomorrow. You can't predict that. Tomorrow, if the commodity cycle revives, right, internationally, countries like Brazil, Russia, which are all commodity exporters, they have generally been punished because commodity cycle has been down. You could see a shift of hedge fund capital into where they see the profit is highest. So that's a bit of smart, hot, whatever adjective you want to use, you can call it. But the pension money, the long-term money, right, it will come based on the growth potential. And I think this budget has done a lot to give comfort to that long-term finance provider from outside India, right, to commit capital to India. So I think that this will be sustainable and will continue to grow.
Right. So with this, Chakri, earlier as well, your comments have always been that the markets already had a lot of triggers which would take Sensex to levels of 50,000. However, taking the budget speech into consideration, the reforms, the announcements that have come through, how would you actually define your allocation from here on?
I think the allocation is clearly growth. The India's largest companies, whether it's Reliance Industries or Tata Consultancy, these companies grow their revenue in the mid-teens or better. So, growth is actually the mantra for an emerging market and especially India. And, as Sunil was mentioning, countries like Brazil, Russia are commodity intensive. Fortunately, India is still actually a services economy, led economy. Manufacturing, make in India is increasingly becoming a part, but still it's a services economy. Now, these services economies can come back far more quicker than a manufacturing companies. And given that this focus, a number of ancillary industries whose service will also benefit. And I think that will be our approach in looking at investing. And so we have to broad base rather than a narrow set of companies.
Right. So overall, if you have to select 2 to 3 sectors from here on, Chakri, which would they be?
Now, clearly, one is the financials. And second, within healthcare, not the regular pharma, but for various pharma providers. Then the ones which are going to be supportive to the infrastructure industry, cement companies, product companies like Cummins, various building material companies, all these companies which have a cyclical bent and where the growth, earnings growth and revenue growth will come back, will be the sectors that I think we would focus on.
Right. Sunil, coming to you as well, what would your reallocation look like? Any new opportunities that you would highlight from here on?
So there are two things here. I agree with Chakri's allocation in terms of the financial space, because I look at it as a BFSI space and not just the banks. So it's banks, it's financial services companies, and it's insurance. So I would look at NBFCs, good quality NBFCs there. I would look good quality wealth managers, asset management companies, right? So I would look at the whole basket of BFSI. Again, on infra, again, I would look, like Chakri mentioned, I would look at the persons who are going to benefit from the infra spend, right? Not just the ultimate infra project. So I would look at cement, building materials, paints, PVC pipes, copper, metals. So the whole paraphernalia which would benefit from that. So those who agree. What I will add to one more here is that I would add consumption, not on the FMCG side, but on what I would like to call it as discretionary consumption. So what do I mean by discretionary? I see that it's having 3 components. One is consumer durables. And why? Because I think that since everything looks at it YOY, this summer, last summer was a washout for the refrigerators, the air conditioners and everything, because it was a lockdown period. And that's their big season. So I think this summer, you're going to compare it to the base and you're going to have a blowout quarter. So I think that's one thing which I believe is going to deliver much better earnings than market expectations. The second aspect is auto. Because in auto, what you've already seen the numbers, right? Numbers are coming out better than expected. And we think that with the rural harvest, I think a lot of money in rural India, because I think 2 Rabi and Kharif crops have been good. The harvests have been good and they have a lot of money with them. So I think that auto, which is already rising, the tractors have had a blowout year, your 2-wheelers and your cars. But like Chakri mentioned some time ago, I think that the commercial vehicle segment is still in a deep cyclical downturn, but it's a matter of time. Today, valuations are still reasonable, and I believe that investing in them will give you a good uptick as the cycle turns. That's the auto aspect. Then there's another aspect to consumer discretionary, which is housing. Right? Again, because it's linked to the real estate sector, huge employment generator. Again, because it's construction, it again has 8 or 10 industries which need to support. Every house that comes up needs cement, steel, wood, PVC pipes, electrical wires, paint. So, right, I see a multiplier, and I think that property prices have been stable. States like Maharashtra and Karnataka have taken this bold step of reducing stamp duty phenomenally. The government has also extended the affordable housing package for 1 more year, and interest rates are soft. Today, you have sub 7% for 20-year loans. Right? So I think that there's a sweet spot there around the broader discretionary consumption, as I call it, which also I believe is a good story to play. So I would add that as a story to what Chakri already mentioned.
Absolutely. In fact, Chakri, with this, with regards to where the custom duty change goes, do you think the steel as a sector is going to be a key loser of this?
I doubt it in terms of, yes, there is going to be some marginal impact, but largely, domestic demand for all these reasons is for steel, for the various metals, is going to pick up. So what you make up in volumes, there's some amount of that pricing will overall match up. And mind, if you look at any of these large companies, you take Jindal Steel, Tata Steel, they all valuation-wise, they are still not expensive stocks. And second, so when you have with the economy coming back and all the strength, so their businesses are going to improve. And as businesses improve and translate into future profit, I think overall net, it is still a good sector to look at.
Absolutely. And then moving from here on, as we know with regards to healthcare as well, now we've seen a sharp jump in allocation by almost around 137% coming in there. Now, do you think beyond vaccines, the focus is to create health infrastructures here over the next 5 to 7 years? And that's something which will benefit the pharma sector as a whole, Sunil?
So I think there are 3, 4 layers to this, and Chakri, I think, referred to it briefly in terms of saying. So we all tend to look at the healthcare as pharma, export-oriented pharma. I think that's a very narrow look, right? I think there's a much broader field there. So what are the fields? There's diagnostics, right? People's awareness. What COVID has brought is people's awareness that they need to look at their health, their willingness to do. So there's diagnostics. Second, there's hospitals. Right? Hospital infrastructure. As we discovered during COVID, we are woefully short in terms of number of beds per 1,000 people. Right? The third is medical tourism. Right? It's a huge, when you create this infrastructure, the whole African countries, the East Asian countries, there's Russia, there's so many people who want to come for affordable healthcare. The cost of a bypass surgery in India is 10% of the cost in the developed countries. So there's this huge opportunity for medical tourism to generate income. So I think that healthcare is a far wider play. And I think and then on the pharma side, right, you have this capacity because, see, we were heavily dependent on China for APIs. So when the COVID crisis struck, remember there was a concern on, is there going to be an API shortage in India because China has got affected on the supply side. So building healthcare infrastructure where we can get more self-sufficient on the API, right, part is again great. And finally, of course, is the fact that when you then go to the export side of the pharma, you build all this infrastructure. I think education quality-wise, India's pharma and biotechnology and other higher-end education in the medical space is unmatched. I talked about setting up new National Institute of Virology, So I think it's a very wholesome package. And really it looks at healthcare as a more universal look than very narrow, pharma, a low cost, substituting a generic supply, and basically, trying to come around the whole product patent and do a process patent. The historic India, that's very different from what pharma is today. So I think that's where I like the budget, the way they've approached this in terms of very, very nuanced and broad based.
Right. So with this, Chakri, let me take a question with you with regards to real estate now. Steps like, say, a 1-year tax holiday for affordable housing projects, an extension of an additional deduction of interest up to 1.5 lakhs on loans for affordable housing. Do you think this will be enough to revive this sector, which has already been ruling under pressure because finances have been difficult for them? Uh, though last 2 to 3 months, we've seen good sales coming in with regards to at least the Maharashtra numbers. So overall, do you think this is enough?
There's one word which is very important, and it's called confidence. And when people are confident, they will go out and make these big ticket purchases. If you look back at 2003, 4, 5, kind of India's mortgage rates were in the high double digits. But that didn't stop people from going out and buying apartments in the first real estate boom of India. Now interest rates are half of what they were at that point in time. So I think, of course, there's been a real estate problem of supply building up, prices being high. There were various industry issues, but RERA has brought a certain amount of transparency. Today, you have a built-up inventory which an builder is looking to offload because it frees up his company's capital to move on to the next project. And so I think a combination of both, where you see an economy coming back, therefore a consumer is more confident to go out and make a big ticket item. And to help him or her, the interest rates are also low, very low. I think, and companies, the real estate companies, are willing to, offload their inventory, which they were not about a year or two ago. So, given all this, I think real estate companies, valuations wise, also are not demanding. And so, from that perspective, you will see, but you have to be selective because these are long gestation and high debt companies. So, a great amount of care has to be taken in choosing such companies.
Absolutely. And then with this, Sunil, clearly, if you go to see another aspect that everyone was considering is that over the last couple of months on the back of the pandemic, enough has been done by the RBI, the stimulus that has been announced as well, that's mainly addressing the supply side of the issue. Now, taking into consideration, the anticipation was that the next leg of growth or the next focus point for the government should be how to increase consumption from here on. So, do you think measures for a short to medium term boost to consumption is something probably was missing from the budget?
I think, yes, I agree that was missing, but I think that there is a limited amount that when you have a pie, you cut out the parts that you want most important. Whatever's left has to be kind of not sacrificed, but I think decisions have to be taken. And while, like I said earlier, it's like a consumption, I look at it as giving a man a fish, right? Capex and that part infrastructure, I look at as teaching them how to fish. I think the sustainability of that over a period of time. Consumption, you just feed him. You give him a farm loan waiver. Every farmer has the money. He'll go and spend something. So you'll see the short-term bump up. So it required great courage, according to me, because it was the thing which nobody could have objected to. Oh, people are in pain. People have just this. I'm giving away a little bit. It would have been the easy thing to do from a social welfare kind of a thing. It would have been talia from the ground level purpose. But I think the government did the right thing by not focusing on that. I think that there's a natural pent-up consumption demand which will come in because I think if we look at it, right, a segment of the migrants and the junior, very low-level people did that lose incomes. But you look at the middle class, the upper middle class, and the rich, they just had potloads of money and they didn't have to spend because of the lockdown. So I don't think there's any shortage of. So this is a confidence level. What Chakri also referred to, right? That confidence level to go back and go see a movie, go buy high-end apparel, go enjoy yourself, do a holiday. I think that there's enough money in the economy to do that. And I think if you look at the number of taxpayers, I think the government showed the data. There's a huge spike in the amount of taxpayers in the country. So I don't think that consumption needed too much support, except at the lower end of the thing. There again, in the agri side of things, I think the two monsoons have also taken care that people are not starving. There's some money there. So I think it was okay for the government not to have focus on consumption for the various reasons that I just pointed out. But purely from a numbers perspective, you'll say, yeah, I didn't get the allocation that infra got. So I
Hmm.
think it's the right
Right,
thing.
right. And Chakri, from a market perspective as well, would hospitality, tourism, aviation be an avoid from here on for some time?
Not really, because these sectors will come back, and they'll come back. Sunil was mentioning that they did not give specific packages, stimulus packages to the hospitality industry or not. But if you create a multiplier effect, you create a confidence, then people will want to go out on a holiday. So aviation companies, a hotel company, all these companies will benefit. Yes, it will translate into earnings not immediately, but a few months down few quarters down the road. But and that is precisely the reason why one should look at these companies, because if you look at a future profitability, if there is a potential, and some of them are trading below their book values, they have all these hotels, etc., that are built up, where and the stock price is below their book value. So I think, but in these kind of companies, because there is a huge amount of leverage, again, selection is crucial.
Absolutely. I think selection and, being diversified is the key over here, as Sunil was also mentioning. Very lastly, if you have to take the money market and the bond market into consideration, Sunil, there is a fear that there might be a sustained hardening of yields because yesterday, the kind of sell off that we saw in the bond market, do you think that's signaling something? What would your view be on the yields from here on?
So I think that uh, we have to face the fact that the government has a huge borrowing program.
Hmm.
To a certain extent, there will be a crowding out of the private sector from a money market, from a capital market, debt capital markets perspective. That's undeniable because government needs money to spend. You say, right? They've indicated 12 lakh crores borrowing next year. They've indicated 80,000 crores for the next 2 months.
Hmm.
Clearly, there is going to be a crowding out effect. Second is that I don't think there's going to be further rate cuts from the RBI. I think we've reached the bottom of the rate cut cycle. There could be a pause cycle for some more time before they raise it, but I don't expect another rate cut to happen. So you've already seen the bottom of the rate cut cycle, according to me. Now, as if the budget is really growth oriented, with growth comes inflation. It may not be hyperinflation, but from the 4.5 to 5% to 5.5 to 6%. So you have a rising trajectory for inflation. You have a government which is going to borrow more, and you have the growth impetus happening in the economy. I don't think the situation is conducive for a softening of yields. So I think a hardening of yields is generally, I would say, the way forward. And that's the way it should be. And Chakri pointed this out some time back in terms of the fact, if you look at the fact that Indian corporates borrowing were actually higher when rates were higher, because if they see the need to put capacity and they see a reward, cost of the interest is easily factored into the cost of the project, because as long as you're able to pass on that interest cost through higher demand, because when demand is higher, the pricing power is with the producer. So, that factor of it means that rate sensitivity. See, when people are down, they cry for interest rates. But when they see demand, they don't bother about interest rates. They need money today. So I think that's the fundamental flexion point at which we are. So I would say that from a debt markets perspective, it's the right time, according to me, to focus on accrual and focus on a floating rate kind of a situation. Well, I would definitely say 6 months, 1 year, 2 years, 3 years, your coupon rates are going to rise and you're going to make money from accrual rather than from betting on the duration part of the curve. So I think fundamentally that is the aspect of debt market. So I think as long as you position your portfolio in that fashion, you can still make decent money from the debt markets comparable to your fixed deposits or anything else in the market. But that being said, yes, definitely, I don't think that betting on interest rates going down and doing those kind of strategies is something which is wise at this point. That's my viewpoint.
In fact, apologies for the disconnect. I think some issue with the internet. But Chakri, coming to you as well on the same, do you think that the budget's aggressive borrowing plan will need deft management with the RBI as well from here on?
RBI has done a good job, and I think they'll continue to do more of the same. And yes, there will be, as Sunil mentioned, some amount of crowding, but I think it is manageable. And clearly, I think, if you look at, let's take capex as an issue. Now, last year, whatever capex was supposed to have happened did not happen for because of lockdown. So now this year's capex again, if let's assume COVID never happened at all, then the certain amount of capex would have happened in 2020, certain amount of capex would have happened in 21. Now that whole capex will now be bunched up in 2021 and outward, and the government has given PLI and various schemes to help companies make up their mind. So that is happening, and there is a rotation of the velocity of money increases. It provides enough capital to other sources, and of course, capital markets are very important. But corporates can raise money from capital from outside and from domestically and from overseas. So I don't think that will impede the corporate India growth going forward, at least for the next few years.
Right. So, Chakri, if you have to give 2 to 3 recommendations right now on the basis of the budget, what would you recommend, which could be your top favorites right now?
I think, like what Sunil was mentioning, I think diversified approach, which is more a multi-cap approach. The broader market clearly is going to see a lot of traction, and growth-oriented focus is important. And clearly, equities, I think, are a place to be rather than debt.
Okay. And Sunil, what about you? One aspect that I would want to get into the picture right now is the divestment target as well that we missed. Do you think that is not very ambitious? Because the overall thrust on privatization has worked well for the markets. And if you talk about the FY22 divestment target as well, it's around 1.75 trillion, and that may be met given the deal pipeline and favorable market conditions.
Yes, I think the probability of that happening is very high for two reasons. One is that the target itself is lower than last year's target of 2.1 lakh crore. Second is the fact is that all these divestments, they were planned last year. A lot of homework has gone into it, a lot of study, and I think there's a state of readiness as far as they are concerned. So I think, in fact, I was a touch disappointed with the low divestment target. I thought that last year's 2 plus adding a few more PSUs into the kitty, they would have even touched 3. But anyway, I think that's where the pragmatism of the finance minister came into play, like under promise and over deliver. So I'm confident that this time they will do it. And I think that the ideal thing to me is the timing. They should front load it in the first half of the year because the capital markets are buoyant. Your valuations are going to be good. And then you have a clear visibility for the second half in terms of your fiscal deficit. Otherwise, what will happen first 6 months, you'll see that 100% of your fiscal deficit you already done. And then you have a pressure to do the divestment to catch up, play catch up. So I'd like to see the government do it smartly. I'd like them to take advantage in the first half itself to do that. Because then any fresh divestments which they think of, they can implement in the second half. So I think that's that. And it'll also give comfort to the rating agencies that the government is serious about non-borrowing capital raising, right? In the thing. And the GST collections and the income tax collections, if they support it, I think then we are in a good space for the second half. So my only wish on the divestment is that they front load and do it quickly, because I suspect that their homework is already done.
Absolutely. The homework is already done. So divestment is something that needs to be considered. And very lastly, Chakri, let me take the GST question with you. Overall, the anticipation is that one nation, one tax is something that we are watching out for. Do you think rationalization of GST rates on certain sectors is something that could be another trigger point that we should be watching out for, which could be announced by the GST Council?
I hope it happens, but I think there's still some ways to go because the government itself is, trapped for revenues. We're tinkering a bit with their current structure, might be a bit too premature, but I know that there is a thinking out there that there could be some amount of rationalization.
Absolutely. Hoping that everything works in our favor and the recovery that we are seeing is sustainable. Thank you, gentlemen. Thank you, Chakri, Sunil, so much for joining us on the show. Pleasure to speak to you. I hope you enjoyed the conversation as well. Thank you and stay safe.